So our investor, I mean, we are still continuing our private client. Our investor has set or has shared some objective that after a certain time period or after a particular number of years, he will have a need of a particular amount, say 1 million, 1 million BDT. He will need to have to meet his investment objective, like purchasing uh, purchasing a home at, for example, at some places, say Aftab Nagar or Bosundara. Okay, so the thing is that as a wealth manager, you have a you have to look after the investment of your client for this number of period. Okay, you are right now here. I mean, for example, 0, and this objective is going to be met after 10 years. Okay, but the thing is that uh, what does it mean, the objective? That means after 10 years from today, and the client needs to have 1 million to purchase this home. Okay, but the reality, you can easily expect that by having 1 million, you can't purchase a home in purchase a flat in Dhaka right now. Okay, but in reality, this number is unrealistic. But for our example, we just have taken 1 million for simplicity. Okay, so what's the point here? That means so client has given you something. Client has given you some capital. Client has given some of his cash, and it is also he has also made commitment that he will make some periodic investment in this period, and this investment will grow at a certain rate, say 6%, 5%, or whatever the rate you can project at a real return, it will grow, and so that it the client will have 1 million after 10 years to meet his investment objective. So you need to immediately estimate that the investment, the amount what is needed after investment horizon to meet the investment objective can be sufficiently sourced from the investment client will make and the investment return that will be available during this investment horizon. So after a realistic assumption, if it is such that the amount of investment what client is expecting to make in this period and in the initial time also, and the return, given the return available during this period, the amount of investment client is making in this period and initial will not be sufficient to have the 1 million after 10 years. That means client is making some investment with you that is not sufficient to meet up his investment objective after the investment horizon. That means the capital is not sufficient. Capital is not sufficient. You probably have solved this kind of problem in your financial management course. So in solving the annuity problem or the present value of cash flow problem, that if Mr. X requires this amount of money after 10 years, how much he need to invest today, or if Mr. X requires this amount of money after 10 years, how much periodic flow he has to invest with his wealth manager given the required rate of return or given the available expected rate of return of this percentage. So in that case, what you need to do, you need to advise your client that it is not possible to meet up your investment objective given the investment commitment you are making and the available return what I'm expecting to generate from the market based on my expectation. So what will be your recommendation to the client in that case? You need to increase your investment. to meet up this investment objective successfully. Otherwise, you need to adjust the investment objective if you can't if you can't increase the capital investment you are making. So as a wealth manager, what you need to do, you need to make a capital sufficiency analysis, or alternatively it is known as capital need analysis. Okay, so there are two approaches for making this analysis. First of all, two approaches are deterministic forecasting and Monte Carlo simulation. The approach what you commonly use in your solving problem in finance course, those are mostly deterministic forecasting, that it is said that that you are here at 0 point. After 10 years you will require this amount of money to meet up the investment objective, so that you expect a certain percentage of return, and 6% or 10% like, and you project that uh, capital will grow at that compound rate to this value at a constant rate. You expect that 6% constant for 10 years, or 6% constant for 15 years. You project like this. Uh, have you ever changed this 1 plus I? Can you recall? When you calculate this, sorry, you take the future value. Okay, you take the future value, and when you make this projection by this form, okay, it is very likely that what you don't do changes in this rate. You assume that it is very constant given the number of n period. So this is kind of deterministic forecasting. It is very simple and it is very easy to solve, and it is a kind of a straight line assumption. But the thing is that it is very unrealistic. But because the I, think of this I does not remain constant. That means the expected return you are expecting to generate from the investment is not a kind of a straight line. In reality, it is like this. Okay, so you need to have this kind of reality to be faced when during the investment horizon. So this kind of problem, which has not been solved by the deterministic forecasting, is solved by the Monte Carlo simulation. So what kind of Monte Carlo simulation generally works? In case of Monte Carlo simulation, you expect different return to be happened in during your investment horizon based on the return distribution. So you're familiar with several kind of distribution from your applied statistics course, that there is a normal distribution, there is a positively skewed distribution, negatively skewed distribution. In case of return distribution, it is not likely that you expect a normal distribution. Rather, in case of return distribution, negatively skewed distribution is more likely. That is it is unlikely that you will have a very high return in most of the time. Rather, it is very likely that you will have low return in most of the time, and it is very unlikely that you will have and which is very unlikely that you will have very high percentage of return. So what is the reality, or how Monte Carlo works? Based on that some distribution of return, you will have some return numbers. So let's assume that it is 0 and it is after 10 years. So let's assume that it is 1.1 million. We require 1 million after 10 years. And it is 1.1 million, it is 1 million, it is 0.9, it is 0.8, it is 0.7. it is, for example, 0.1. Okay. So based on the probability for that expected return, you are thinking of based on the random, it is likely that you will get your return generated in this way, or you will have a several number of trial. In rule of thumb, there will be approximately 1 million trial in simulation, 1 million trial. And if it is likely that based on your probability distribution and based on the assumptions you are making for this Monte Carlo simulation, in let's say in most of the cases, you see here most of the cases are here, not here. Okay. Remember, it is 1 million, it is 1.1 million, and these are number less than 1 million, or which will not meet investment objective. Okay. So if it is such that after making Monte Carlo simulation, in most of the cases, the higher probability goes to those amount which will not meet the investment objective. That means with some realistic probability and several return assumptions, in most of the situations, as the lines are very higher, lines are very concentrated here, you need to assume that in most of the cases, it is likely that you will not be able to meet up the 1 million requirement after having a, say, you have made investment of 0.5, say 0.1 million today, or for zero. If it is likely that it is not possible to meet up the investment objective in most of the cases, or in most of the time, that means higher probability to this area where it is unlikely that to be able to meet the investment objective. In that case, you need to immediately call the client that it is not possible to meet up your investment objective given the investment you are making and the capital market expectation I'm making for the investment horizon you have said to me. So in that case, what you need to do, you still need to believe your Monte Carlo simulation. Rather, you need to request your client to adjust the investment what he is making, or if he is not rich enough to inject more capital to with you, you can request him to meet up his reduce his investment objective based on the investment he is making and based on the projection of return that is going to happen during the investment horizon. So that is the idea of Monte Carlo simulation. For the course purpose of this, you need to just have the idea that how deterministic forecasting works and how Monte Carlo simulation occurs, or Monte Carlo simulation works. But for advanced portfolio management, or when you will be the portfolio manager, you will try to learn that how you can implement this so that you will have the technology to meet to understand the capital needs for your private client. So in today's class, we will try to concentrate more or spend most of our time to construct the investment policy statement for our client. From your investment analysis course, so far I have gathered information. You have given an idea that what are the components of investment policy statement, and you have got a general idea. But in a real portfolio management environment, it is very, very important that you have a very thorough idea, not only with the components of investment policy statement, rather you have the skill. Don't forget the technical skill and the soft skill of portfolio manager. One of the technical skills of portfolio manager is that you have the knowledge that you can construct the investment policy statement for your client. So it is none other than a kind of prescription you can compare with what you get from your doctor, that the doctor listens to a patient with a much concentration, that what kind of problem or what kind of goal the patient is expecting to achieve. And based on the patient's condition, a doctor prescribes something, or doctor discusses that what kind of solutions uh, you can utilize for solving this problem or for meeting up your objective. So you can compare with that. And in particular, for particular individual private client, you need to expect that it will be very diverse. You can't expect that it will be very common across the private investors. So it is a kind of document, and what it tries to achieve, it tries to document all of the objectives and the risk tolerance profile and the investment horizon and the constraints of uh, investor is likely to make during his investment. And the thing is that based on the IPS, you can make your wealth manager responsible, that if wealth manager does not comply with the IPS, you can sue against the wealth manager that he does not follow the IPS what was constructed based on our mutual discussion. Okay, so it ensures investment discipline, uh, not only from the wealth manager perspective, but also from the client perspective. For example, you have in IPS and you already have made investment with your wealth manager. So your say your horizon is, for example, investment horizon is 5 years. You have made a commitment with your wealth manager. But if it is such that after 2 years your mind has changed, you want to withdraw money from your investment. So in that case, when the IPS exists, you are committed that you will make your investment up to 5 years. So you will think twice before requesting withdrawal to the wealth manager. Say in your IPS, you have mentioned that you will not make investment in speculative stock. Speculative stock, you will not make investment, very high speculative stock. So if it is such that in a in the midst of the investment horizon, wealth manager has made investment in some speculative stock to boost up the profit in the client account, so that wealth manager can show that I have generated higher profit in your account compared to what was expected, so that so please give me a percentage out of this. So in that case, how he has made this? He has made this profit by investing in a speculative stock which was restricted in the IPS. In that case, you can argue against the wealth manager that it was not recommended in the IPS that you can make investment in high speculative stock. So when the IPS is there, investor focus is usually long term. Investor focus is usually long term. Investor can't withdraw his investment in a short term. Investor focus is long term. So what is the advantage of long term focus from the perspective of investor? The advantage to the wealth manager is that wealth manager can don't require the frequent rebalancing, frequent trading in the account of client, so that the risk goes lower, overall trading risk goes lower, and he can avoid the short-term volatility. A wealth manager can avoid the short-term volatility because his focus is not short-term, as the client has mentioned that his focus is long-term. So for long-term, you can have a long-term commitment with your wealth manager. Okay, and the IPS is a professional requirement for working as a wealth manager. Uh, if you claim that you are a professional wealth manager, you need to make sure that you have an IPS with your client, so that you maintain some prescribed policy, mutually negotiated policy in implementing the investment decision and the portfolio management decision. So in the first component, what are the information or what are the components you need to include in your IPS for the client? Most of the information what you have learned in previous session regarding collecting the basic financial information which have been collected from the investor during the conversation with the client. You need to summarize the information and you need to include those information in the first part of the investment policy statement. What is that first part? That first part is background and investment objective. Remember, this is the number one item of the IPS, background and the investment objective. You can't start IPS by writing the constraint. Okay, you need to start by describing the profile of the investor and by describing the investment objective. Okay, then the other things will follow. I'll show you after this. So what are the background information you can include in the IPS, or you need to include in the IPS? That kind of brief personal profile and the financial profile of the investor, and you can also include the profile. You can include the age of the investor. That is a good information which directs the investment strategy. And we also have learned about the client goal in previous session. So the matter is that you are already familiar what kind of goal in client will share with you. But the matter is that there are some goals which are continuous, or and some goals which are one-time goal. For example, if client has shared that I have a goal that after 5 years I'll visit a pilgrim so that I will require a good amount of travel expenses. So it is a kind of one time. Okay, but compared to this, if client goal is to meet up the annual funding, annual lifestyle expenses, in that case, it is kind of ongoing objective. It is not a one-time objective. In previous session, we also mentioned that you need to work with your client as asset manager that to quantify the objective as precisely as possible, because when you can't quantify the investment objective, rather for example, if a client tells you that I want my investment grow at a high rate, it cannot be objective. It's a kind of there is no definition of high. You need to ask your client what kind of return you think that it is high. Is for some investor 10% can be high. For some investor, like for real estate owner, their high return is not 100%. Their high return means 400%. So when there is this kind of ambiguity, your total investment plan will become will not work. So you need to ask precisely from your client that about the investment objective in a manner that is much detailed and that is much quantified. But in some cases, it is not possible for the client to precisely mention his investment objective. For example, that client wants to client wants to mention objective such that I will donate to a orphanage after 10 years, which will cover their daily expenses for say 3 years. So there are so many question marks here, because you don't know after the investment horizon what will happen to the daily expenses of this orphanage, and how many people will be there in orphanage who will require these expenses. Okay, so in that case, what is the suggestion to you as a wealth manager? The suggestion to the wealth manager is that wealth manager will work with the client continuously. The IPS has been constructed in general sense or generally in this time, but client has to wealth manager has to work continuously during this period, during the investment horizon, to get more updated information about the investment objective from the client, so that during this period of time he will have a good estimate how much amount will be required to meet up this investment objective. So it is not a kind of a static or one point of time decision, rather it is kind of continuous process to get more update, so that you will have a quantifiable investment objective. And why you are suggested to have continuous engagement, because the information will change and more information will be available in coming days. Okay, and in background and investment objective section, you will also need to mention or you'll need to ask from your client that other than the wealth you are managing with me, do you have other wealth which will also uh, be used to meet up this particular investment objective? For example, a client has said that I will have a apartment in this area and it requires a big investment. So client is actually planning to make some cash flow from this asset. uh, let's say it is a existing apartment of the client, and client is also wanting to make investment from make the cash flow from his wealth he is managing with the wealth manager. So if wealth manager who is managing this portion of wealth of the client does not is not aware of the alternative asset client has with him for meeting up this single investment objective, the portfolio allocation for wealth manager will not be precise, because some portion required for meeting up this investment objective will come from another asset which is not managed by the wealth manager. So you need, as a client, you need to share this information with your wealth manager. Then some goals. Of course, there are some goals which are most important compared to other goals. So you need to ask your client which goals are primary goal, which goals are secondary goal. For example, of course, the expense requirement for children's educational expenses will have more priority compared to another objective or another goal, that I will be traveling to a particular country after this year and I will require this amount of expenditure. So between this objective, the educational expenses for children is should be the primary objective. So you need to ask precisely what is the primary goal you need to pursue from your investment, so that you can include that primary and secondary goal in the IPS. And in IPS, you need to mention what is the market value of the portfolio at the on the date of zero, or in the date of zero in which you start your investment. And you need to ask about the tax status of your client account. So there are some accounts in which you can defer taxes. You only pay taxes when a client withdraws money from the account. And there are some accounts in which the tax is applicable always when the capital gain is made, not the time when it is actually withdrawn. So there's a difference between this taxable account and the tax deferred account, and you need to ask from your client that what kind of account you want to have for this investment. So let's look at illustration that how a real background and investment objective section of a private client IPS can be. Okay, so let's look at what we just have understood. Let's say this background has mentioned the client name, David and Emila. Okay, and they have mentioned, and that means client wealth manager has mentioned the objective. What kind of objective for the David and Emila? The objective of the investment is to meet the expenses for current lifestyle, provide for their family needs, and fund their philanthropic objective. But the matter is that you see immediately that there are several objectives. So as a wealth manager, you don't like to see all these objectives in a equal footing. So you need to ask them uh, which objective among these three is the primary. So they have mentioned that their primary objective is to support their family members and to uh, make expenses or contribution to charitable aspiration. You see that they have ignored the objective to maintain the current lifestyle. So it is not necessary that I will have or this client will necessarily maintain the similar lifestyle what they are currently maintaining. Rather, they will try to emphasize on to meet up the expenses what will be necessary. So it can be such that the lifestyle will deteriorate after when they will receive the amount from their investment. And you see between current maintaining current lifestyle and the philanthropic uh, contribution to philanthropy or contribution to charitable organization is more prioritized in this IPS. Okay, so you have got what are the primary and the secondary. And now if I ask you which objective is the secondary objective can be maintaining the current lifestyle. So as a wealth manager, you need to focus first on which objective? The primary objective. Okay, and they have mentioned that they anticipate the approximately this amount will be needed per year in inflation adjusted portfolio distribution. Okay, this is kind of requirement to meet up their expenses or life expenses or the family expenses. But the matter is that they also have mentioned they intend to purchase a second residence within next 2 years. Within next 2 years. So it can be like a secondary objective because in primary objective they have mentioned what it needs to be. But they also have mentioned that it is approximately 1.5 million. So when they have mentioned their objective in quantifiable manner, and as they have mentioned, it is approximately, they wanted to give you a precise number. That's why they have shared this number. So it is a kind of right way of mentioning this kind of objective. So if it is such that they would not mention this, if client mentioned that I expect to purchase a second residence in, for example, Baridhara, so I don't know how much expense I will make. So in that case, it can be such that the apartment can be 5 crore taka or apartment can be 2 crore taka, but you don't know. what kind of preference your client actually has. So you need to ask what kind of apartment you are planning to purchase from the location you have mentioned. Okay, but you see, they have not articulated a specific dollar amount for what purpose, what they will give their children. They have not mentioned. So in that case, what you need to do, you need to ask your client continuously during the investment horizon that what amount you are right now thinking to give to your client. Okay, and in that case, as you have not mentioned, your client has not mentioned the specific dollar amount, as a wealth manager, what you need to do, you have mentioned that I'm not taking this objective as a granted, because I need to work with you continuously for what? For what purpose? For quantifying this objective. Then what are other parts? Then expected in establishing their asset allocation, David and Emila have considered their current asset and expected cash needs. They are seeking to achieve a higher long-term rate of return and are willing to assume the associated portfolio volatility. So in this case, you have got a confirmation that they want to achieve a higher return and they are prepared to tolerate the volatility associated with higher return. And they have mentioned that I will have this kind of tax account. You see that their joint account is taxable. Their joint account is taxable. That means when there will be gain, it will be taxed. But they also have included other two accounts which are tax deferred account. So in that case, when there will be gain, it will not be taxed. Rather, it will be taxed when the fund would be withdrawal from fund would be withdrawn from the account. So it is the portfolio value what they are wanting to make right now. It is the current combined market value of the portfolio. Okay. So in second component or second part of the IPS, you need to mention the investment parameter. What are the investment parameter? You already have come to learn from your investment analysis course very slightly, and also have got some idea from your previous session that you need to share with your wealth manager as a client, that how much risk you can tolerate in terms of the percentage or in terms of dollar amount, that how much you can absorb. Okay, so other than this, you as a wealth manager will ask your or will assess your client that how risk tolerant your client is. He can be high risk tolerant, he can be moderately risk tolerant, he can be low risk tolerant. So in previous session, you already have seen that questionnaire can be used, or which is commonly used by the wealth manager to know that how risk tolerant your client is. For example, one questionnaire can be such that which is very common question to you. Uh, you think of this question when you choose between a private job and the public sector job. So what choice you make, or which is chosen by you between employment which offers you a fixed salary and another job in which your compensation could be higher or lower than the fixed salary, or some mix of the two, that some fixed salary and some performance bonus, for example. So in corporate sector or private sector, for this kind of combination or this policy, their compensation is significantly higher in corporate sector compared to the public sector job. But you see the average people or the average job seeker in our country look for a job which has a fixed salary regardless of the performance, regardless of his commitment, or regardless of his showcasing of the ability in his or her job. So in that case, if your client, for example, picks a answer like entirely fixed salary, you immediately recognize a scale, and you will see that, for example, if you rate in this way, 1 high risk, 2 moderately high, uh, or 1 very high, 2 moderately high, 3 high, in this way, you need to immediately recognize that your client is not very high risk tolerant, rather his risk tolerance is very low. Okay, based on this, wealth manager assess the risk tolerance of his or her client. So you need to mention that uh, document, or uh, what kind of way you used uh, to assess the risk tolerance of your client. And if you use risk assessment or risk tolerance questionnaire, you need to attach that in appendix of the IPS, and you also need to mention in the risk tolerance part of the IPS that I have used the risk tolerance questionnaire to assess the client's risk tolerance. And you need to ask that about the investment time horizon of from your client. In most of the cases, a client is likely to mention a very short investment horizon. In case of private client, based on they underestimate their life expectancy, they underestimate their income potentiality from their job. It is likely, it has been found that, but in reality, it is found that their investment horizon is usually greater than what is estimated by the client, or what is thought by the client, because client continues to earn return or earn flow from his or her business, or from alternative sources, and he or she lives for a uh, longer life. So in that case, the investment horizon usually becomes higher compared to the client's mentioning of the investment horizon. But you need to give the idea that what potential are available with different investment horizon. So if your client is very short term focused, that his investment horizon is 6 months, okay, in that case, if you can't convince your client to make investment for example 10 years, in that case you need to share with your client that to make a good amount of return from long-term instrument, it is not likely that you will make investment for 6 months. So in stock market investment, it is a common complaint among the investors that they can't make return, a good amount of return, what they expected. So they have been asked how long you are making investment in a stock market. They will tell you 6 months. So you need to answer them, 6-month investment in a stock market is not a good investment horizon for making us good return. Rather, make investment for a long time to make a good return from a stock market investment. So if you ask me how long I am investing with Grameenphone, the answer is only for 2 years. Okay, so I can't tell you that I have generated good return in these 2 years. The answer is I have not made a good return in 2 years. But if you ask another investor who has made investment in last 6 years, you will get immediate answer that he has made return on equity more than 80% in 6 years. So if your investment horizon is short term, the stock market is not for you, because the stock market does not encourage making investment for short term. Rather, the short term market is different, money market is different. So with having money market focus, you can't make investment in long term capital market. You have understood the very basic distinction between capital market and the money market is not based on the instruments, but based on the investment horizon, based on the tenure of the instruments. Okay, the capital investment or the capital market is always long run, and the money market is always short run. So you need to convince your wealth manager that if you have investment time horizon is very high, your preference will be for making investment in a stock market or making investment in private equity, of which you need to wait for a considerable period of time. So you can't expect that you have made investment with a very new company still, which is trying to prove its potential, and you have made investment for 6 years, and you are disturbing your wealth manager that why this investment is not giving good return. Your wealth manager has no answer, because the investment will require, for example, 5 years investment to see that how it performs. Okay, so in that case, if you as a wealth manager, you need to precisely mention that what kind of benefits are available with different investment horizon. And most important is that in investment horizon statement, you need to ask from your client that how long your investment horizon is. And if it is a very short term, it is a very short term, for say 3 years or 2 years, you need to you can mention that it is less than 10 years. And if it is your client is say, your client says that my investment horizon is 18 years or 20 years, you can broadly mention that investment horizon for my client is more than 15 years, or investment horizon exceeds 15 years. And you need to ask precisely what kind of asset class he prefers. So as a wealth manager, you may be biased to some asset class, but you need to ask the asset your wealth sorry, your client, that what kind of asset class do you prefer. It's not merely ask that do you prefer bond and or bond or stock. It's not the kind of simple question. You need to present the historical return in the bond, historical return of stock, and you need to present the correlation between this, and you need to present the return from private equity, return from real estate investment, and the standard deviation along with this investment. And then you need to mention that what kind of opportunities, what kind of risk are associated with each of the asset class. You can't presumably assume that your client your client has very good knowledge about the asset class preferences. Rather, you need to teach your client about the asset class profile. So knowing the asset class precisely is a good technical skill for wealth manager. So based on that, you need to ask that what kind of asset class you prefer to make investment. So in sometimes client mentions that I don't like making investment in uh, fixed return asset class because I like to avoid the interest income because of my religious restriction. So in that case, you can't include the fixed return instrument in the client's portfolio. Okay, though the investment in fixed return lowers the volatility of the portfolio because of the low correlation uh, with the investment in a stock market. Okay. Then other preferences you need to ask from your client. So one example which you can mention with your client that has become very popular for last several years and is still getting momentum in developed world, that is ESG investing. Is a kind of investing in which investor focus on environment, society, and the governance. The company which have a high score in this ESG, you like to, as a client, you like to make investment in this ESG stock. So based on the good performance in future, based on the good performance in the past, as a wealth manager, you mentioned that BAT will be a good investment for you. But based on the ESG, you need to exclude this from the asset class for your particular client, because your client does not want to make investment in a stock which does not comply with the ESG parameters. Okay, and you need to ask the liquidity preferences of from your investor, that when you will it is likely that you will require this amount of liquid or cash from your portfolio, and how much of your portfolio balance you like to maintain as a cash balance instead of having invested in uh, the asset classes you have preferred. So from your investment analysis, it is likely that you have uh, heard that the prudent decision for investor is to make a 6 months reserve of the lifestyle expenses, and if uh, then after depositing this in your bank account, the remaining amount you can go for making investment. But in our investment community, it is observed that people don't maintain this. So what point we are preferring here, or what point we are trying to stress here, it is not this 6 months balance. Rather, after 6 months balance you are maintaining with your bank account, you still have, for example, 10 million to make investment. So you have made this investment with your wealth manager, and to your wealth manager you have mentioned that out of this 10 million, don't go for making investment of this 10 million entirely. Rather, make 0.5 million available as cash balance, which may be invested later, or it may be withdrawn by me at a certain point of time. So we are mentioning about this in the liquidity preferences. The 6 months balance is not with the wealth manager. The 6 months balance is with you yourself. Okay. So you need to ask about it. And there are some other constraints what you can ask from your client. For example, if client mentions that uh, I am from Khulna. I am from Khulna. My house is at Khulna, and I prefer to make investment in KPCL, Khulna Power Company Limited, because I see the potential of this company very high, because it is near to my home. So instead of having the financial potential, client may prefers making investment in KPCL, because client believes that KPCL will be a good investment because he has a home bias. It is in behavioral science, it is known as home bias. Uh, though there are good potential with the companies which are in foreign countries, but people are biased to the countries which operate in their home country, or their near home location. So you need to share this kind of preferences which we mention here as a constraint. Okay. So in risk tolerance, what we have mentioned, that you asked from your client and you have concluded that there is a kind of illustration that your client is able to accommodate the short and intermediate term portfolio volatility in this you have mentioned. Okay, but if it is such that the it has not been mentioned that long-term volatility can be tolerated by the wealth manager. But in case of hedge fund, for example, hedge fund is not a private client, just for illustration I'm telling you. Okay, hedge fund can tolerate the long-term volatility. For example, for 2 years, for 3 years, or for 5 years, the market is not going well. So the hedge fund has a tendency, or hedge fund has the observation capacity to tolerate this. But for private client, it is unlikely that they will have tolerance for long-term volatility. Okay, so in model portfolio behavior, which appendix you have added, what does it indicate? It indicates that the risk and return profile you have shared with your client, and client has mentioned that between this, which one I like to prefer. For example, here in model portfolio statistics, it is okay. There should be an editing. Yeah. So you have mentioned to your client that from your short-term debt instrument, the expected return is 2.5%, standard deviation is 2%, and based it is in terms of simple return. In terms of compound return, the return looks like this. Okay, so based on this standard deviation profile, and based on the correlation and the covariance profile you have mentioned with your client has preferred a few of this stock, and based on that risk tolerance statement from the client, you have mentioned that your client acknowledged that he knows about the volatility of the asset class in which he prefers to make investment. And you see this statement is important, that he has mentioned a long-term investment horizon that exceeds 15 years. So based on the asset class preferences, he has included this short-term debt instrument, intermediate term bond, US stock, non-US stock, global real estate securities. Remember, he has not included anything like cryptocurrency. He has not included anything like private equity. He has not included anything like investment in hedge fund. So what do you think? You think that he does not have the preferences for this asset class? Okay. So what are other other investment preferences? You can see that he has a bias, or he preferred to make investment with a company which was his former employer. So instead of analyzing its financial value, he has preference for this. So you need to address this. You can't tell your client that you can't make investment. You need to address this preference of your client. It can be specific. Okay. And you see also that David has an interest in a private real estate limited partnership that invests primarily in office building throughout Asia. So he has mentioned Asia not based on the geographical or continental differences in asset class return. Rather, he mentioned the Asia based on his biasness. Okay. In liquidity preference, he has mentioned that he wants to have a minimum cash balance in his portfolio of how much? Approximately 50, or not approximately, exactly $50,000. So as a wealth manager, you can't make investment of this 50,000. You need to make this cash balance available for your client. Okay. And he has also mentioned that he has significant embedded capital gain. It is related to the tax issue. So you need to address that when he has a capital gain, significant capital gain, what kind of tax account you need to pick for your client. Okay, Khalid, you have raised your hand.
স্যার ভুলে ক্লিক করছি
Okay, okay. So portfolio asset allocation, it's starts with the in the implementation stage. Portfolio asset allocation is very essential or very important part. You already have shared the profile of the asset class, and you already have realized what kind of profile your client has, and you want to recommend a strategic asset allocation. So let me give you an example. What do you mean by the strategic asset allocation? Let's say for simplicity, your client has mentioned that my investment objective is to maximize return, maximize return, maximize return. Okay. So from your mean variance portfolio optimization lessons you are currently taking from the alternative class of portfolio management, you probably have learned that based on the maximization of return, how I will allocate for asset one, how we allocate for asset two, how we allocate for asset three, asset four, in this way. And there is also to minimize the risk, what can you do? You can you can get the weight in this way to minimize the risk. Okay, so these are very simplistic calculation for 2 asset class or 3 asset class. But for multiple asset class, what we do a solver function by presenting our return and risk and the correlation estimation, and we need to apply the solver function to get how much weight I need to allocate for this. Okay, so based on the investment objective like maximization of return, you have got this number. So these are kind of strategic asset allocation, and you have mentioned that it is to be 20%, it is to be 30%, it is to be 10%, it is to be, for example, 40%. Okay, so you are very strict with this percentage, and you have mentioned that it can be lower range can be 18%, lower range can be 22%, lower range for it can be 26%, for it can be 34%, in this way. These are kind of a strategic asset allocation. So where your weight is fixed in a particular asset class and you are giving some upper and lower bound. But the problem is that with this kind of asset allocation, when the market condition changes, you are not continuously determining your strategic asset allocation weight. So when the market condition changes, it is likely that the optimal weight will get changed. So if it is not a strategic asset allocation, rather it is a kind of tactical asset allocation, in that case you want to take the advantage of market movement. So for example, the market is such that equity market is likely to be favorable for having meeting the objective of maximizing return. In that case, when in a strategic asset allocation, you are fixing a percentage weight here, you are now telling in tactical asset allocation, you like to make investment between 19 to 21%. In 19 to 21% in equity. So in that case, you are mentioning, you are not specifying exact weight, rather you are giving a range, you are giving a target range. You are not unhappy if your equity weight gets 19% for market condition or gets 21% for market condition. Okay, instead of fixing a specific weight, you are giving a range of weight so that you can take the opportunity of market movement when market moves in a favorable direction for some certain asset class. Okay, So let's say in this case, the wealth manager has taken the decision of a strategic asset allocation. So if the client, you as a wealth manager prefers a strategic asset allocation, tactical asset allocation has some advantages and also has some disadvantages of in terms of risk perspective. So when client, you are preferring a strategic asset allocation for your client, what you need to do, you need to mention this kind of asset weight you are giving, along with the rebalancing limit, that if it your asset, if your for example short-term debt instrument weight goes to 8%, you don't need to make rebalancing. But when it is below 8%, say 7.8% or 7.5%, you will make a rebalancing to come to the weight of strategic asset allocation you have made initially. Okay, it is just portfolio asset allocation. What you are seeing in tabular format, it is simply in graphical format. And you see for your client, you have preferred which asset class. First one, US stock 35%, non-US stock 25%. Then the third is intermediate term bond 20%, and for short-term debt investment 10%, and global real estate securities 10%. So these are asset allocation you have picked for your client. And in case of portfolio management, this is an ongoing process which is essential, and you have to make some points clear. Like I have mentioned about the discretionary portfolio management to you in previous session. So what kind of discretion or what degree of discretion as a wealth manager you will have need to be clear by making discussion with your client. Okay, so from asset management companies, say Ideals Asset Management Company or Longkabangla Asset Management Company or IC Asset Management Company, you will probably heard about this kind of term DPM, discretionary portfolio management, and non-discretionary portfolio management. So discretionary portfolio management department manages those portfolio in which wealth managers have full discretion. Uh, in general sense, it is full discretion with the wealth manager that how the weight will change, or how the what asset class will be picked, or what assets will be taken, and when it will be sold, or when it will be bought, or how much when rebalancing will be made, this kind of decision. But in case of non-discretionary, okay, in most of the brokers account, the BU account, what we try to maintain with simply broker, and we don't give the discretion to the brokers that to manage our client, manage our account. In that case, you are not giving any discretionary authority. You are not giving any authority to the wealth manager to make any selling or to make any buying in your account. Rather, you are managing, you are negotiating, or you have a commitment with your, or you have a, you have mentioned in your IPS that for any rebalancing decision, for any significant decision, you need to make call to you. So sometimes in your in financial newspaper, you see that some brokerage companies have sold out their clients account, their clients portfolio, and BSEC has initiated action against those brokerage account. So the thing is that in a brokerage house, it is very likely that their accounts are non-discretionary. So broker has no right to sell off the portfolio of client without taking explicit permission from the client. So that's why it is it is a kind of offense to not to take discretion, not to take the permission from the client when it is mentioned in the IPS that it is to be taken. Okay. And rebalancing part, you need to mention in the portfolio management section that when you will make rebalancing in the client's portfolio, it can be based on the time interval, or it can be based on some other parameter that when it will differ from some threshold threshold reference level. So it needs to be clear. And technical changes, the matter is that if the market condition changes and you make consultation with the client that I will make some changes based on the situation, in that case you need to mention that how it will be implemented and how it will be changed, and you need to take it approved from the client. Otherwise, if client does not want to make any technical changes in his portfolio, this section will not be in IPS. Okay. And in implementation part, what as an asset manager can do, asset manager or wealth manager can use the third-party money manager or use the proprietary investment offering. The thing is like that, asset manager, say Ideal's asset manager or Ideal's asset management company is managing asset of their clients. At the same time, IDLC asset management IDLC has some of their own investment product. So if it is likely that your wealth manager is trying to implement your or execute your portfolio by making investment in their own in-house developed instrument, in that case it is kind of proprietary investment offering. But it is not very likely in our country because the investment company does not provide a comprehensive offering of all investment offerings. But in JP Morgan or Vanguard, you see they have the different divisions and their investment offerings are too many. So based on the client's preference, and client needs to ask from wealth manager needs to ask from the client that you prefer to make investment through our offering, or you need to make investment with the offering of other third party companies. So when you will select the other third party companies, you need to make it clear that I will make a due diligence, or I will check the issue, or I will check the information and the current status of that manager periodically, so that I will not pick any company offering which is not doing good, or of which the governance is not good. Okay, so you'll get some illustration from this. You see the wealth
Sir,
manager. Yeah,
স্যার রিব্যালেন্সিং এন্ড টেকনিক্যাল চেঞ্জের মধ্যে ডিফারেন্সটা একটু ক্লিয়ার হয় না স্যার।
in case of rebalancing, you are just changing between strategic asset allocation, and you have mentioned some rebalancing lower limit and rebalancing upper limit. Okay, so it is not like that you want to take opportunity for changes in market condition. Rather, for movement in the market, your asset weight has changed to and crossed this, or goes down beyond this low limit, or goes up exceeding this limit. In that case, you want to make rebalancing. Okay, but in case of tactical asset allocation, what you are doing, you want to in tactical sense, you want to make the you want to take the opportunity of market movement. For example, market is moving in a way which gives high return for US equity. which gives high return for US equity. So in tactical asset allocation, what you are doing, you want to say that from the asset allocation what I have made, I will give more weight now when the US equity return goes from 10% to 15%, for example. So here you are taking the opportunity of extreme movement in the market to a favorable direction what you are speculating. Okay.
Okay, sir. Yeah.
Lavanya, you have asked, you raised your hand.
Sorry,
Uh,
wealth managers
Can
due
I
diligence.
stop? Can I stop you and ask? Take your question after having the class finished.
Okay, sir.
Okay. Okay. So the client has the wealth manager has mentioned how the discretion authority and rebalancing and the implementation will work for this client. You can have a look at this, and duties and responsibilities, which is the in the final part before the appendix of the IPS of a client, and what kind of responsibilities wealth manager must execute need to be very clarified in the IPS, so that if asset manager does not obey the responsibility in line with the mentioning in the IPS, you can make the wealth manager responsible. For example, I'm trying to give you an illustration like for example, it is very common that for your client as a wealth manager, you will make a tax reporting every year. So what does it mean? You from your tax course, business taxation, you probably have come to know that in 24D, there is a investment tax rebate facility for making investment in selected instrument like stock market, savings certificate, like these things. Okay. So as a evidence, you need to attach a document which is available from your wealth manager that you have actually made investment of this amount in a particular year. So if you can't attach this document, you can't claim the investment tax rebate from the tax authority. So it is a regular responsibility of your wealth manager to make this reporting with you. So every day I receive the financial reporting of my statement from my wealth manager or from my mutual fund. In my case, in general, I'm saying that mutual fund is my wealth manager or mutual fund manager is my wealth manager. Just for giving you an example, it is not the exact wealth manager or private wealth manager what I am trying to mention. So in this assessment year, when I'm ready to submit my income tax return, I see that one of my asset managers has not shared the tax statement with me, so that I can't attach the document with my tax return to get the tax rebate. So that I was worried that what will happen. So I have sent several email to them, and they have not responded to me. And then I made communication with their chief investment officer personally in non-official platform. And at 11 p.m. Before my tax return submission day, he has mentioned that I apologize for not reporting this tax statement to you. I'm taking immediate measure to have this statement available to you. So on probably 1 a.m., that means at late night, okay, I have received my tax statement for this account along with this kind of email. Okay, so what they have mentioned, they have expressed sincere apology. What's the point of expressing sincere apology? Remember, providing tax certificate, providing tax reporting is one of the major responsibilities of wealth manager. That's why they have expressed the sincere apology for not providing me with time. Okay, And they also have mentioned that this unpleasant experience of yours will not necessarily impact our relationship in future communication. So from this email, you what is the purpose of sharing this document with you? That is to understand that how important it is or how significant it is to comply with the responsibilities as a wealth manager. And remember, you are not other kind of private secretary. Private secretary is not managing your financial wealth, but you are having a fiduciary responsibility. So as a wealth manager, you need to be very careful to maintain these responsibilities so that you will not lose your client for a long time. Okay. And in the duties and responsibilities, another part that is to be mentioned, that is at which interval you will review your IPS. Remember that IPS is not a statement that it is has been made. For example, today is I forgot today's date. It is 24th.
Yes, sir.
Okay. So 24th November, you have made an IPS by consulting, by having a long discussion, 5 hours discussion with your client, for example. Okay, it is not like that. It will continue for 5 years. Okay, you need to review the IPS periodically. It can be 1 year, it can be 6 months. You will check that the objective what your client mentioned initially are still exist similar after 1 year or after 2 years, and you need to see that whether the constraints changes, preferences changes for your for your client. Okay, so that is the part of IPS review. And in appendix part, you need to include some statement like for supporting the IPS. So what kind of a statement are the things you need to give an idea about the portfolio behavior, specifically the return behavior of your portfolio, so that your client will have an idea that how your portfolio will move along the investment horizon. Okay. So the thing is that you have learned very well about the percentile from your state 1. So it is the thing is that this portfolio in 1 year time horizon, it is in a 1 year time horizon, there is it is 10% likely that the asset return will move, or the portfolio return will go below 10.45%. And in 50 percentile cases, in 1 year, it is it is 50% likely that your portfolio return will go below 6.23%. But you see, when your investment horizon is going upward, I mean for longer investment horizon, you see you are moving to a favorable direction. That means your amount of loss or likelihood of making loss is getting lower. So you have shared this document, and these are kind of 50 percentile, the our median. Okay, median percentage, or in the distribution, the median is known as 50th percentile. So you have shared this, and based on this portfolio return distribution, your client will it will be easier for your client to understand that how his or her portfolio will move along this investment horizon, and they will understand their portfolio behavior. And another thing is that is important and good amount of resources have been allocated in the professional knowledge to understand the capital market expectation. So it is not such that what you are doing in your portfolio management, that based on the historical return, you are projecting this expected return, then expected variance, then you are expecting the correlation such that it is not like this capital market expectation. The thing is that regardless of the previous, or instead of looking backward, you are looking at forward, and based on how the economy will move, how the industry will move, how the business will move, you are expecting some return and a standard deviation of the asset classes based on your expectation of the economic parameters and the business parameters. Okay, and based on that, you are coming with some numbers, which is compound annual return. And you know the difference between simple expected return and the compound annual return, where in simple annual return, if the monthly return is, for example, 1%, we multiply this by 12 to get the annual return like this. But in case of compound return, what we know that it should be like 1.01 to the power 12 minus 1. You get the return in this way. So as a wealth manager, you need to share the compound return, not the expected return based on the simple or average calculation. So the statement what I showed you earlier in as a portfolio statistics, or the asset class return and the standard deviation and the model compounded return, is not based on the past story or based on the past history. Rather, it has been made on the capital market expectation for the coming coming periods, which fall on the investment time horizon. So in next session, we will try to have a look on the investment policy statement. The components are similar, but there is a good amount of difference, as you have acknowledged that there are differences between the private client investors or private investors and the institutional investors. So their IPS must reflect their differences, and there's a diversity across the institutional investors, ranges from the defined benefit, defined contribution plan to bank, insurance company, then foundation, then pension fund, then endowment. All these are institutional investors. So in next class, we will try to have a look on the how investment policy statement for institutional investors look like in a very brief form, because for each of the institutional investor, good amount of reading has been devoted in professional education, but for our time constraint and the class constraint, it is not possible to spend a good amount of time for have a detailed look on the investment policy strategy for each of the institutional investor. Okay, so that's all about for today. Let me stop the